Gold didn't just rally, it broadcast a stress signal, the kind that shows up when confidence starts drifting out of paper promises and into something that doesn't require anyone's approval to be valuable. Here's the number that resets the entire conversation. On Monday, January 26, 2026, spot gold pushed through $5,000 an ounce and printed an intraday all-time high around 5,110.50 per ounce, before trading back near 5,090. Let that sink in. 5,000, and then over 5,110, as an actual traded price, not a forecast, not a slogan. A move like that looks simple on a chart: price up, line up. But the real story isn't the metal. The real story is what the metal is quietly judging: currency trust, policy credibility, and the market's tolerance for uncertainty. When gold breaks records during a global crisis, it's rarely about gold. It's about the system. Because gold is the asset that tends to move first when the world starts asking uncomfortable questions like, what happens if policy gets messy? What happens if trade conflicts escalate? What happens if currency volatility spreads? What happens if the rules keep changing mid-game? To understand why this matters now, it helps to understand what gold responds to faster than almost anything else: real interest rates, the dollar, and tail risk fear. Real rates are the inflation-adjusted returns available in the safest bond markets. Gold doesn't pay a yield, so when real rates are high, holding gold has an opportunity cost. But when real rates fall, or when the market suspects they can't stay high without breaking something, gold tends to get stronger. And here's what makes this moment unusually revealing. The 10-year TIPS real yield, a widely watched gauge of long-term real rates in the United States, sat around 1.92% on January 23, 2026. That is not a low number, which means this gold move is not just a textbook rates down, gold up story. It's something more primal, the market paying up for protection, even while the usual headwind is still present. That kind of buying pressure doesn't come from a single place. It comes from the plumbing of global markets: futures, spot, currencies, and physical flows, all interacting at speed. Start with spot gold, the price for immediate delivery. Spot isn't a single exchange. It's a network of dealers and liquidity venues that trade gold around the clock. A major hub for wholesale physical gold trading is the LBMA, the London Bullion Market Association, where large institutional participants transact metal in the over-the-counter market. OTC simply means trades negotiated directly between counterparties rather than matched on an exchange. Now add futures. On COMEX, the commodity exchange, part of CME Group in the US, gold futures contracts trade enormous volume. A futures contract is an agreement to buy or sell an asset at a set price for delivery at a future date. Most contracts never result in delivery. They're used for hedging and speculation. But futures still matter for price discovery because they concentrate liquidity and leverage. Leverage is a double-edged sword. It amplifies gains, and it amplifies forced selling when the market moves the wrong way. That's why a gold breakout is rarely one clean story. It's a chain reaction. Currency moves change the dollar price of gold. Bond market expectations change opportunity cost. Futures positioning changes momentum, and physical demand either confirms the move or fades. Even the relationship between spot and futures carries information. In contango, futures trade above spot, often reflecting storage, financing costs, and normal market conditions. In backwardation, near-term prices can trade above futures, sometimes signaling tightness or strong immediate demand. Gold doesn't live in backwardation the way some industrial commodities can, but when pricing relationships get unusual, it's a sign the market is under stress. Now zoom out. What kind of environment produces a $5,000 gold print? Historically, it's an environment where trust gets fragile. In 2008, gold wasn't just responding to bad news. It was responding to counterparty fear. Fear that the system's promises might not be honored the way people assumed. In March 2020, gold initially dipped during the liquidity scramble, then surged as the policy response became clear. Massive intervention, massive balance sheet expansion, and a reminder that constraints can change quickly when stability is threatened. Today's setup rhymes, but with a modern twist. Instead of a single shock, the stressors are layered: trade conflict risk, political uncertainty, geopolitical tensions, high debt loads, and the ever-present question of what money is worth when policy incentives collide with economic reality. And the market has been voting with price, not with commentary. Reports tied to broad market coverage have described gold's surge not as a gentle climb, but as a powerful acceleration through late 2025 into early 2026, with safe haven demand and policy uncertainty repeatedly cited as key drivers. That framing matters because it aligns with what gold historically does when the world feels less predictable. But the biggest structural driver is the one that moves quietly: central banks. Central banks don't buy gold because they feel bullish. They buy gold as a reserve asset, as a hedge against currency risk, as diversification away from concentrated exposure, and as a strategic store of value that doesn't carry another country's credit risk. According to World Gold Council data, central banks added about 1,045 tons of gold in 2024, topping 1,000 tons for the third year in a row. That's not a one-off, that's a trend. And trends like that act like a slow tide underneath the market, not guaranteeing a straight line up, but changing the baseline level of demand. Now pair that with investment flows, particularly through gold ETFs, exchange-traded funds that often hold physical gold in custody and issue shares that trade like a stock. ETF flows are a window into institutional appetite because they represent broad, scalable allocation decisions. In the first half of 2025, reporting cited roughly $38 billion of inflows into gold ETFs, with holdings rising by about 397.1 metric tons to around 3,715.9 tons by the end of June. Separate reporting tied to World Gold Council figures cited total net inflows of roughly $88.5 billion into global gold ETFs across 2025. Those are not small numbers. They represent a meaningful shift in positioning, capital choosing gold exposure at scale. And then there's total demand. World Gold Council reporting has described record-level annual demand totals when including OTC investment. For example, around 4,974 tons in 2024 under that broader accounting. Again, not a weekly headline, but a structural backdrop. Gold is unusual because most of what has ever been mined still exists. This isn't oil that gets burned. That means the market isn't purely a function of mine output versus consumption. It's also a function of willingness to sell. And at record highs, willingness to sell can decrease if holders interpret the move as confirmation of rising instability. That's why breakouts can accelerate. Rising prices can increase supply through profit-taking, but they can also tighten available supply if enough holders refuse to part with metal during uncertainty. Now bring this back to the chart, because charts are where behavior becomes visible. When a market reaches all-time highs, there's no overhead resistance. That can make price action feel unstoppable. But technical analysis still provides a map of where the crowd is likely to react. The first level is psychological, 5,000. Big round numbers matter because humans anchor to them, and institutions often structure risk around them. If price pulls back, the key question becomes whether 5,000 holds as support, or whether it breaks and triggers a cascade of de-risking. The next meaningful reference is the prior record, D zone. Reports cited record highs near 4,850 earlier in January 2026 before the bigger push above 5,000. Former resistance often becomes new support in healthy trends. If pullbacks respect that zone, it suggests the breakout is being absorbed rather than rejected. Momentum also matters. Indicators like RSI, the Relative Strength Index, tend to surge into overbought territory during parabolic moves. Overbought doesn't mean must crash. It means risk of a sharp pullback rises. In other words, the trend can remain bullish while price still whips violently. Moving averages add another layer. When price stretches far above the 50-day and 200-day moving averages, it's a sign of strong trend, and also a sign of fragility. Stretched trends usually do one of two things: consolidate sideways to let the averages catch up, or snap back quickly in a sharp mean reversion. A polite, gradual descent is the exception, not the rule. Now, the part that separates analysis from cheerleading, the bearish case. A move to record highs increases opportunity and increases danger, because the same forces that drive a fast rise can unwind fast when conditions shift. One bearish scenario is a sudden shift in rate expectations. If the market begins pricing higher real rates for longer, or if inflation expectations fall while nominal yields stay firm, the opportunity cost of holding gold rises and speculative demand can fade. Another bearish scenario is de-escalation. Gold thrives on uncertainty. If trade conflict rhetoric calms, geopolitical pressure eases, and markets re-embrace risk-on positioning, capital can rotate away from safe havens. When that rotation happens after a large run, the drawdown can be sharp. Then there's positioning. Futures markets amplify moves through leverage. Late cycle buying often becomes crowded buying, and crowded trades can get ugly. A small dip triggers stop losses. Stop losses trigger margin calls. Margin calls trigger forced selling. Suddenly a pullback turns into a waterfall, not because the long-term thesis changed overnight, but because mechanics took control. There is also policy risk, not a conspiracy, a reality of incentives. When currency markets become disorderly or inflation expectations become politically painful, policymakers have tools: job owning, liquidity operations, regulation, emergency measures. Those tools can change short-term market behavior even if they can't rewrite long-term fundamentals. And finally, there's the too obvious problem. When everyone agrees gold is the safe haven, it becomes crowded. Crowded trades don't fail only because they're wrong. They fail because too many participants need liquidity at the same time. So yes, gold at record highs can still be bullish, and still punish anyone who confuses a powerful trend with a straight line. Now comes the key reframe. Even if gold pulls back, the structural drivers may remain intact. Central bank buying has been persistent and unusually large in recent years. Investment flows through ETFs have shown the capacity to surge when macro uncertainty rises, and the backdrop, policy uncertainty, trade friction, currency volatility, is exactly the environment where gold tends to earn a premium as insurance. This is not just inflation hedging. This is confidence hedging. Ask a simple question. What does the world look like when gold is over $5,000 an ounce? Part of the answer can be math. Years of inflation compounding, currency purchasing power eroding, nominal prices rising across many assets. But part of the answer may be more uncomfortable. The market assigning a higher probability to policy mistakes, geopolitical escalation, and financial repression. A world where nominal returns can look fine while real purchasing power quietly erodes. That's why gold can remain supported even when a single variable doesn't explain it. The bid can be coming from a mosaic of fear, strategy, and institutional allocation, not just from one economic indicator. So what matters next is not whether gold deserves to be here. Markets don't care about deserving. What matters is whether the conditions that created the bid persist, and whether price behavior confirms or rejects the breakout. A practical way to track this is a simple checklist. Watch real rates, especially 10-year tips. If real yields begin trending down while gold holds above key support, that tends to reinforce the upside case. If real yields push higher and gold begins losing important levels, that can signal vulnerability. Watch the dollar. A weaker dollar can amplify gold gains because gold is priced in dollars globally. Dollar strength can act as a headwind, though gold can still rise if fear overwhelms currency effects. Watch ETF flows. Sustained inflows can signal broad institutional confirmation. Outflows during stress can signal that investors are choosing liquidity over insurance in the short run. Watch central bank behavior as a trend, not a daily headline. Reserve decisions don't change overnight, but persistent accumulation changes the structural demand floor. And watch volatility. Gold can behave differently in slow-motion crises versus sudden liquidity shocks. In a liquidity event, everything can sell off temporarily as cash becomes king, even gold. That doesn't automatically invalidate the longer-term thesis. It highlights how important time horizon is. Time horizon changes everything. For long-term holders using gold as portfolio insurance, the goal is stability through uncertainty, not perfection at every price. Insurance doesn't feel clever. It feels boring until it matters. For active traders, the goal is survival through volatility. Position sizing and risk management matter more than being right. At record highs, price can move violently in both directions, and leverage magnifies that violence. For investors building strategic exposure, the goal is discipline. Chasing parabolic moves is emotionally satisfying and often financially punishing. Staged allocation, rebalancing, and clarity about why gold is in the portfolio can reduce the risk of buying at the most euphoric moment. For newer participants, the goal is understanding, learning the mechanics. Spot versus futures, LBMA versus COMEX, real yields and currency effects, the role of central banks and ETF flows, builds the ability to interpret the next move without panic. Now, a final reality check. Record highs are exciting. Record highs also create overconfidence, and overconfidence is where markets collect their toll. Even the strongest bull markets breathe. They pause, they pull back, they shake out weak hands. That is how trends remain healthy rather than collapsing under their own weight. So the clearest way to frame this moment is asymmetry with humility. On one side, the upside case. A world of heightened uncertainty, persistent official sector buying, and scalable institutional flows can sustain a gold premium longer than most people expect. When confidence is the variable being repriced, gold can behave less like a commodity and more like a signal. On the other side, the risk. Parabolic moves invite violent reversals. Crowded positioning can unwind brutally. Policy shifts can change short-term narratives fast. A sharp pullback is not only possible, it's normal in markets like this. That's why the most important decision isn't a prediction, it's a plan. A plan that defines what would confirm strength, holding above 5,000 after pullbacks, stabilizing around prior breakout zones, sustained institutional flows, and a plan that defines what would signal danger, breaking key support, accelerating volatility to the downside, sudden exits from risk hedges as liquidity becomes scarce. Because the real message of gold at all-time highs isn't get rich. The real message is stability is being repriced. And when the market reprices stability, it tends to do it before the headlines catch up, not after,